Hello, I'm Sam Stovall, Chief Investment Strategist of CFRA Research, and thank you for tuning in to this presentation titled A Weighty Issue, Sector Weightings and Market Tops. Let's take a look at the next slide before we get started, in which I tell you that this presentation is for informational purposes only and is not a recommendation to buy or sell securities or to engage in any investment activity. Let's take a look at the first slide. Many investors are well aware that the equal weighted S&P 500 over the long term has outperformed its cap weighted peer. Indeed, since 1990, the equal weight 500's compound annual growth rate has exceeded that for the cap weighted benchmark by about 150 basis points per year. Yet if we look over the last 3, 5, and 10-year period, we actually see that the reverse is true, that the cap-weighted S&P 500 has done better. I think mainly because investors have been focusing on the FANG stocks, many of those companies in the communication services, technology, and consumer discretionary category, which now represents such a large portion of the S&P 500. But is that a concern? Let's take a look at the next slide. Today, what we see is that the top 10 stocks within the S&P 500, and here we show the sector in which they're found, ticker, the name of the company, what the market cap is, what each company represents, as well as the cumulative for these top 10 companies. You can see sliding down the percent cumulative column. These 10 companies represent 28% of the weighting of the S&P 500 index as of the beginning of September. On the right-hand side, we see 10 of 11 sectors. Energy is missing because it is the smallest, but we find that technology is the largest at 28%, followed by healthcare, which is about half that size. But let's take a look at the next slide, which actually shows us what the top 10 stocks represented back at the market peak in early 2000. We see here the top 10 stocks had a similar cumulative weighting of 27%. Many of them, again, were in the technology sector with a smattering of representatives in industrials, energy, financials, as well as consumer discretionary. Tech back in 2000 represented 33% of the weighting of the S&P, with the second largest group, financials, at 13%. So you could say, well, gee, today looks an awful lot like it did back in 2000. Maybe there is something to be worried about. Let's take a look at the next slide, and we'll actually find that on every 5 years, we find that many sectors traditionally have been leaders. I'm showing in blue those sectors that have the highest weightings, and then in orange, those with the smallest weightings. We see back in 1980 that energy represented more than 28% of the S&P 500. We also see back in 2000, as well as 2015, 2020, that tech was close to or above that 20% threshold. So we've seen many times in which sectors have had very high weightings, very low weightings, etc. Let's go to the next slide. This is probably the most important slide of this conversation, because what I did was, starting back in December of 1999, toward the end of the tech bubble, what we did was, with the blue line, simply added the market cap percentage of the two largest sectors within the S&P 500. The red line is the summation of the top 10 sub-industry representation. And then when we have the orange shadings, the bars that go up to the 50% level represent bear markets, whereas those bars that go up to the 45% level represent corrections or declines of 10 to 20%, while bears are 20% or more. What you'll notice is, not surprisingly, that the sum of the two largest sectors within the S&P represented about 45%, just as the market topped out in late March of 2000. We also find that into 2000, the top 10 sub-industries represented 50% of the weighting of the S&P 500. But that really was the last time in which we had a very high reading that preceded a significant market decline. We see back in 2007 at the head of the financial crisis that the two top sectors, the top 10 sub-industries, were down around the 35% threshold rather than between 45 and 50%. If you look to the correction of 2011, those numbers were below the 35% level. 2015, they were a shade above, et cetera. So it really does look as if you're trying to use sector weights to be a good indicator of potential market declines. It would end up simply being an exercise in futility. Let's take a look at the next slide. And what we'll find out is that a better way of looking at market weakness or strength comes from breadth. Well, what is breadth? It's basically the participation, the percentage of stocks, or in this case, sub-industries within the broad market benchmark that are participating in this advance. There are 147 sub-industries in the S&P 1500 index, and the 1500 represents the large cap 500, mid cap 400, and small cap 600. The chart on the top left shows the rolling 10-week or 50-day moving average. Today, what we're finding is that percentage is at 19%, well below one standard deviation below the mean. Yes, it does indicate that the participation has been very weak as this market has gone into a bit of a tailwind thus far in September. But we've gotten to a point that, gee, maybe we've been oversold and we could actually see a short-term bounce. If you look to the chart on the bottom right, what you find is that now the percentage of sub-industries trading above their 200-day moving average, also their 40-week moving average, is at 64%, which is equal to the average over the last 30 years. So what is this telling us? Well, certainly that the participants are falling off by the wayside, certainly in the short term, but also in the longer term, which is traditionally not a very good indication for the market ahead. Why is that the case? Let's take a look at the next slide. What we find in this very simple analogy is that a carriage that is drawn by 6 horses can travel farther and faster than one pulled by only 2 horses. So if you only have a couple of sectors and a few sub-industries that are really driving the market, that means that this advance is vulnerable to an upset should any of these drivers really fall by the wayside themselves. There will always be leadership within the market, but the important thing to look at is participation of the followers. You need a large amount or a heavy breadth in which to then sustain the traditional direction of this overall market. So with that, I find not the sum of the market cap weighting of sectors or sub-industries to be important, but the percentage, the number of those that are participating in this overall trend. Let's take a look at the next slide, because I also feel that back in 2000, valuations told a very different story than they tell today. Back in 2000, investors thought that technology was still a screaming buy, even though it was trading at a price to earnings ratio based on NTM or next 12-month earnings at 57. So a 57 PE versus today's 27, I think puts technology in a much better footing today than it was back in 2000, just before the tech bubble burst. Let's finalize things with the next slide. And what we will see is, in summary, breadth is very important, and wide breadth, it's most important to appreciate the furthering of a particular trend. Narrow breadth, or a very small percentage of sub-industries or companies participating in this move, typically results in either rotation from cyclical sectors possibly to defensive sectors, or an outright retreat or sell-off in the market. Today's sector and stock dominance is reminiscent of 2000. However, the valuations, I think, back then were more of a bear market driving force than the valuations are today. As a result, we believe that opportunities still remain for tech, that sector that represents 28% of the market cap today, as well as communication services, which is very different today than it was back in 2000, that both of these sectors still offer opportunities even with this concentration. I'm Sam Stovall. Thank you very much for listening. If you want to learn more about CFRA and its services, as we see in the next slide, simply go to CFRAresearch.com to learn more about our services, to learn about our MarketScope Advisor platform, as well as to get a free trial to our new or I should say technical analysis service offered by Lowry Research. Simply go to the Lowry Research trial on our CFRA website and kick the tires. Thank you for listening. Until next time, I'm Sam Stovall.